you get your money for your business through angel investors. Well, that's exactly what we're going to talk about today. Today, we're going to talk about how you can dip into really the equity side of financing instead of the debt side of financing that a lot of people look into. A lot of business owners look into loans and credit lines and credit cards to be able to get money, or what we call debt financing. But a lot forget that there are a lot of private investors out there that are looking to invest in ventures, potentially just like yours, through angel investment is another entirely cool way to get money for your business. Actually, sometimes easier and better way than other types of debt financing. So what's with us today is Jonathan Hung. Now, Jonathan is a transformative Los Angeles angel investor and venture capital partner who believes in a bright future for businesses seeking to broaden their horizons in North America and Asia. Now, in support of his mission, he serves as co-managing partner at Unicorn Venture Partners and senior venture partner and head of due diligence at Expert Dojo, providing a hands-on approach to supporting companies by offering his strategic expertise and operations management. Jonathan, thanks for joining us today.
Thank you, Todd. Pleasure to be here.
So as I said kind of in the beginning, a lot of people aren't even familiar with private money, private equity. They're not familiar with angel investing, venture capital. So let's start there. Give me a little bit of idea. What is an angel investor? What do you do? What do you invest in?
It's sometimes easier to get money from an angel investor. Angel investors are usually people who are professionals, who've made money doing other things, and they're looking for opportunities, right? They look at the stock market, hey, it's great, but they want to see like, hey, how can I get in early on a company? How can I find the next Apple or Google or Uber, but like really, really early? Like you hear a lot of time angel investors are really the first check-in. It's the friends and family round. In terms of rounds, you look at pre-seed money, right? And it's really like a company under $5 million. In valuation, where an angel investor is willing to take a chance, whether it's like anywhere from 25,000 to a couple $100,000. We're here to really go early and help not just with money, but also with our time and potential like relationships and introductions that we have already.
Sure. Makes sense. So let's unpack some of the things you said. When do you invest? Venture capital versus angel investing. When do you get involved?
Usually I get involved from idea stage. When I look at really like the four things I really look at is the team, the idea, potential customer growth, and then revenue growth. I'm also a venture capitalist. I have a fund as well. And listen, my other partners, they won't let me invest just on an idea. No, it's too early. Sometimes they want to see a little revenue, they want to see some customer growth, or they actually have, a minimal viable product, an MVP ready to go before they want to write a check and accelerate the growth. For me, like I made angel investments where I just met the person on one-time call or one-time meeting or one-time Zoom meeting, and I just like who they were. They seemed to check out. It's less diligence, to be quite honest. Angel investors, you're not doing as much diligence as you think you are. I remember one of my very first angel investments was a company called Miso Robotics. And it's basically came to me and said, hey, we want to build a robot that flips hamburgers. That's it. And they were just like 4 PhD students out of Caltech, and they had no robot ready to go. They didn't need the money to actually grow it. And so I thought, it was interesting. And look where we are now after 2020. And there's a shortage of labor, like that company skyrocketed. But I remember first writing the check when they had absolutely nothing. And most angel check writers would do that, but most venture capitalists will not.
I'm shocked that McDonald's has not created a robot that flips hamburgers. Like you said that, I'm thinking I've seen it on a movie somewhere that happens. That seems like common sense to me to do that. So you said team, and you also talked about, getting on a call with one person. So when you look at the individual you're investing in or the team you're investing in, what is it specifically you're looking for?
Really, it's about trust, because it's not about business plan, because you're going to be pivoting every second, every minute, day to day. We're not looking for like a 1-year horizon. Like you're going to be making changes weekly. So when I look at an angel investment, it really is, do I trust this person? Do I feel that he or she is able to give me what they're saying they're going to do? Because when I look at projections, I'm not going to look at like a 5-year projection. That's just ridiculous. Like there's no way. It's not a Fortune 500 company where we can look at a 2-3 year horizon. It's really like, okay, you need this money to get to a certain point in time, like maybe 6 months from now, before you raise again. Because when you're doing angel investments or venture capital, it's all about raising the next round of money. That's how I know you're going to do well. It's just, you got to get more money in. There's no way one check is enough.
So when you're looking at that, do you have, do you find that, like, what do you find in one phone call that has that kind of trust? Like, what do you see in a potential entrepreneur? So Gino Wickman, I've had Gino on my podcast, real good guy, right? Wrote Traction, wrote Entrepreneur Leap. And he says there are clear traits like for an entrepreneur that you have to pretty much succeed. Do you look at that? Like when you're sitting there talking to somebody, are you looking for set traits that you know they will be able to pivot? Let's be honest. Like I love what you said, because you're like, look, the plan, the projections, that stuff's crap. Like you got to find somebody that's going to pivot when everything goes wrong, because we both know that's business ownership. But what do you find? What are you looking for in that individual that tells you that that person can do that?
It's someone who's truly relentless. Like I have like 4 degrees, right? I have 3 masters. I went to some of the best schools in the world, MIT, Wharton, London School of Economics. You know what? I wouldn't give any of them necessarily a check just because they went to those schools. It doesn't matter what school you went to. It's like, it's more about your EQ, like, the things that you can't get from a book. And you could just tell, like, okay, well, the way they answer questions, if I give them, certain types of questions, they can answer it. And, because I always feel like, hey, if you're smarter than me, not just from a sense of an academic sense, but just like how you view business, how you want to get things done. Okay, that's great. That's what I really look for. Because when you get to a point where like, you've answered my questions really great and you know what you're saying and you have the idea, okay, let's go. But hey, truthfully, you're going to see a lot more failures than successes this early. But you want to make sure that you're betting on somebody who can help you look at the vision really clear in the very beginning.
What about ideas? What kind of ideas are you looking into? Are you looking to something completely off the wall? Well, you tell me, like, when you look at an idea, what makes you go, oh yeah, I definitely want in on that?
Yeah. The good ideas, like, like I'm not a CEO looking for like 5% increases in sales, right? That's great if you're a multi-billion-dollar company, but I need to see companies that are going to grow by 10x. Like, how are you going to grow by 10x in like 2 to 3 years? I'm not going to ask for that for the first year. You're figuring it out. But really, you got to, like, from year 1 to year 2, if you're a consumer company, you got to triple your revenue, right? And year 2 to year 3, you got to triple again. Because you're thinking like you're going from, let's say 500,000 to 1.5 million to like 5 million. That's your trajectory. That's going to get that hockey stick approach where you're going to be able to exit, where you're going to be a force of nature. That's what's interesting to me. If you're showing you're going to make something incrementally better by a couple percentage points, that's not going to make a difference. Like, how are you going to raise money faster in order to grow faster? That's what's interesting to me. And it doesn't matter necessarily the industry. It could be anywhere from consumer to tech to, like, now you hear this key phrase of Web3 and where NFTs are going and crypto, like this new democratized market that we're in. Like, show me how you're going to grow.
What about when you should or shouldn't do this? Because debt financing, loans, credit lines, versus equity investment. From your perspective, when should somebody consider one versus the other?
I think it's about control as well, right? Like, you shouldn't give too much control. Like your first time raising money, you shouldn't give up like, a third of your company right away. Because by the time you raise your Series A, you're going to be diluted so much that it's even worth for you as an entrepreneur to keep going, right? That's the things we have to worry about. Like, I think and you got to help them as an angel investor, because, like, listen, like, you're giving too much away to the company. Like, sometimes you look at those Shark Tank deals, like, listen, the truth is they don't even take those deals. It's just great PR. I know companies that I have, they just go on there to get the publicity, and they never ever they might accept it on the show, but it never gets worked out. So it really is, it makes no sense to give up so much of your company so early. Like, if you're taking, and don't take that much money, like, don't try to raise millions the first time around. I always tell people, pre-seed, you're looking at maybe $500,000 at most, and you could probably get a couple hundred yourself and then find the rest later and give up a little bit of your company to prove the idea out, and then, raise more money and then give up less later on.
So what are there stages of raising money?
Absolutely. For me, it just depends where you are, right? Like, if you're doing less than, let's say $1 million annually, right, in an annual recurring revenue, listen, like, I would say that you're probably under $10 million, depending what kind of company you are, right? And so, but that's a good like lesson. Like, hey, after that, okay, once you're doing, like, basically you look at like monthly recurring revenue. If you're doing 100,000 monthly recurring revenue, that means you're on track to do 1 million. So that means, like, your valuation makes sense anywhere from like 8 to 10 million, give or take. That's why you're doing your seed round. right? Then when you go to your Series A round, you're definitely at the point where like, hey, you're trying to get a million, you know, monthly recurring revenue. So we're doing like 12 million a year. So each stage, obviously, I would say a good rule of thumb, it's not something you would definitely adhere to because, you know, valuations are going crazy now, but you're trying to probably give up 20% of your company, give or take, every round of financing you're doing.
Is there a limit of what you think an entrepreneur should give up before they're done raising capital?
It just depends, right? It just depends how fast you need to grow. Because I tell people this, like it takes one type of team to go from 0 to 100,000 revenue. It's a different team to go from 100,000 to a million, right? In the very initial beginnings, you don't need a CFO, right? If you're a tech company, the most important hires are, if you're not the CTO yourself, is somebody who's a CTO and someone who's great at sales. But usually the CEO has to be the salesperson in the very beginning, right? But once you're doing a million monthly recurring revenue, you're going to build out your team. So you're going to have to be able to give away not just, you know, great salary, but, you know, shares of your company, you know, in the options pool to hire really great talent to help you grow into that unicorn that everybody wants, that $1 billion plus. I mean, unicorns weren't that frequent maybe 10 years ago, but now like everything's raising at that $1 billion valuation. And now like more and more people are looking, well, what's going to be a decacorn? What's going to be worth $10 billion? You know, when it comes to venture.
Well, how do you determine that? Because you threw out just an interesting,
Mhm.
whatever example where you said, a business that's generating a million in revenue, might get 10x valuation. How do you figure out valuation of what you're really willing to invest or what you're willing to invest based on? Like, how do you figure out what the potential valuation to invest is?
Yeah, it's really about growth, like I mentioned before, because you know, sometimes you could have a great company and you don't even have to raise that much money. You raise like $1 million, it could be just a cash cow. Like my family had a great cash cow business. My father probably raised less than $500,000 and made millions of dollars, you know, from contract manufacturing, making clothes in China and selling them here to US, you know, wholesalers like Costco or Amazon. And that's a great business. But when you're looking at like what VCs want to do, like they want to look for companies where, you know, they have limited partners that they have to, invest their money wisely. And they're looking for like 3, 4, 5x returns, right? They're not looking for a typical like 10, 20% return on their money. So that's why I say that, like for certain companies that want to raise and grow at that scale and that want that money, yes, that's the track we have to go to. But if you're just like, you know, a simple mom and pop shop, or you have a great business idea that's great at just making money, hey, you don't have to raise that much money. You can go to an angel investor too and say, hey, if you get me 20%, 30% of my money annually, I'm happy, right? It's better than what I do investing in the S&P or, you know, anything on the Dow Jones. I'm happy. So it really just depends on what the risk and reward tolerance is of each investor.
When you're getting pitched by somebody, I
Mhm.
imagine they have some kind of slide deck or what we call pitch deck together.
Sure.
What do you really look for in that pitch deck?
Um, what I'm looking for, like I said, is the team. I want to hear about their background. It's so interesting because like, why now? You know, why do you think it's right for you to like, I'm sure you had a job before. Why is it, or maybe you never had a job before, you never worked for anybody and you've always been an entrepreneur. Hey, those are things I'd like to learn and understand. Then I just want to understand like, well, what's your business model? Like, how is your company like going to make money going forward? And it might take a while. It might take a while where you have to build a tech up, right? Or you have to have, you know, an MVP product ready to go. That's fine. But then like, how do you grow into that? You know, how are you going to make money going forward? Those are the things that are really important, like the projections and like, you know, your competitors. That's great, you know, but I just want to care about like who you are and then really like what your business model is going forward.
What do you look for like in an elevator pitch per se? Instead of going through all the pitch deck,
Mhm.
it's said that within seconds as an investor, you pretty much have a good idea what's going to happen, right?
Yeah.
And I don't know if that's accurate or not, but that's what I've heard.
Mhm.
So that being said, like, what are you looking for in that first minute of time elevator pitch per se that really you've been there before and you're like, wow, that's
Mhm.
awesome. I'm going to love this. Or you're like, this is not going to be good. I got to sit here for another 30 minutes.
Yeah. It also depends, like you should know your audience. Like I always tell people like, hey, I'm not a biotech investor. If you're going to ask me something about biotech, I'm not the right person to talk to because I would have to go to somebody else in my network to go through. Like what I'm good at is I'm good at consumer and consumer tech and also like, you know, just ordinary tech. and like, whether it's B2B or SaaS, like explain to me like how you're going to transform what you're doing in your particular industry. Because it's not going to be like, wow, all encompassing, I'm going to do everything. Like, look, Amazon just started with books, right? It's just like, tell me what you're going to do that's going to be transformative in your space within the next year. That's all I care about, because I can't look 20 years down the future. It's really about right now, how you're going to do it. And like, does that make sense? Would I know, not just that I would write a check, but then, okay, you get to that point. Do I have the network of people? Well, hey, let me introduce you to this venture capitalist or this person with money, and they're going to put in more money. That's what also I look for too. It's like, hey, it's a great idea, but then once you get to that, like, can I find more people to give you more money to keep growing?
Where can I find initial angel investors? Because what you're saying is something I've heard before, that, the initial angel investor you get is very important because they're the ones that have the connections, the relationships of other angels, other venture capitalists, that you'll be part of that process, helping them get on board to raise more capital in the future. So it seems like your very initial angel investors are very important to the path of the company. So where do you really go to look?
I mean, there's all these great networks. Like I'm part of Tech Coast Angels, right? That's here based in Los Angeles. I mean, you go based where your geography is. But right now, because of where we are with Zoom and everything, like you can find people. I think LinkedIn's a great tool. I mean, you should make sure you have a great LinkedIn profile. You go see who your second or third contacts are and see like, hey, because usually it'll say like in their like headline, this is what they do, right? They're investors or they're angel investors. Go talk to them, send pitches, see if there's like a way to get a warm introduction, not just a cold email. That's probably less likely. Like find connections that'll get you in front of the people you want, right? Listen, and if you find, even if you want to like email Mark Cuban, I'm sure he has, something where like he has an investor will take a look at it and they'll screen through, how AI component to see if it's interesting enough to go look at further. I mean, really just searching the web and taking time to see these networks around you. Listen, depending on the school you went to, every school now has an alumni association that's interested in investing in startups in VC. Go check them out.
So do you find it really is industry specific, meaning venture capitalists and angels kind of like to invest in a certain industry? You mentioned biotech versus software versus consumer goods. Is that what you kind of find is you want to look for investors in your industry segment?
Yeah, in a sense, because you really have to find somebody who believes in you. Look, if you have a consumer company, right, and you're going and like that other VC firm or angel investor, all they know is B2B software sales. They're not going to understand anything, which could be good or bad, right? They might love your product and give you, some money just to see you grow your product, but they're not going to be able to help you grow your business. Right. They might just give you some money. So it's a question of like, do you want smart money or dumb money? And I don't think there's a sense of like, oh, someone's not smart enough to help you. It's just dumb money in a sense like, well, listen, that's all it is. It's just money. Like smart money is like, well, I can help you get into this store, or I know this contact, or like look through my LinkedIn, like who my connections are. Maybe I can get you into Walmart easier or to Amazon easier. Like those are things you want as a consumer company, right? But if you're a SaaS company, like, listen, like, oh, do you know anybody who's at Google or Facebook? Who could give me some background of like, this is what, is there something they're not working on where I could come in and like build product behind this? Because there's a question of build or acquire. Like these multi-billion-dollar companies, they have a lot of engineers and a lot of money to solve problems, but maybe not focused on that. Sometimes as, a startup founder, it's like, hey, I'm doing something that people are not looking at right now. And that's my advantage.
Well, what about other ways to tap into your expertise? I mean, if I'm going to be somebody you're going to invest in, what is it that you really want me to look at with you and go, wow, like your expertise is going to help me in these areas versus it just being an annoyance because I'm relying on you for way more than I should be?
Mm-hmm. Well, for my background, it's interesting because like I've done a lot. I've seen a lot. And sometimes like, listen, especially because I've been done clothing, if you're going to if I see another company that's going to say, hey, we're going to do revolutionize fit, perfect fit. And I'm be like, I'm sorry, I've already invested in that. I just don't see it right now. This isn't the time. Timing does matter as well. Like, and I'm going to give you the best advice I can because I've seen it. I mean, I invested in a company that did that and it didn't work out and they had to pivot into something totally different. And that helped them get acquired recently by H&M. Even though for a little bit of a loss, it was still an acquisition, but I'm glad they survived. Like sometimes, hey, I am perfectly comfortable with a company going to zero. As long as I know the entrepreneur did everything he or she could to make it to the absolute success. Like that's okay for me, because I know going into this, like zero is more likely the outcome. than, you know, something coming to be a multi-million dollar return. What's important to me is, hey, there's ways for me to help. I mean, if all you want is my money, it's not exciting enough for me, because I don't think that's enough, because I want to invest in things where I could truly help and make an impact and get you to the next round of financing. I always tell people, like, as an angel investor or a seed stage venture capitalist, my goal is like a high school counselor. I'm just trying to get you to college. You know, it's like, once you get your Series A money, then that's the next person's responsibility. I'm just here to get you to figure out what your MVP is, what your potential revenue model is, and is there enough there for, okay, you mastered one market, can you go to the next market and then the next market after that? And that's where you get your Series A money.
When do you get paid? You get paid when Series A comes in, or when eventually something happens to that business?
When eventually there's an M&A or an IPO of sorts. And that could be, it's the funniest thing. Sometimes it happens really quick. I've had investments where 10 months later, I got paid because the company just got bought. But then there's times where it's been 4 years and I wasn't even expecting it to happen. You know, literally, like this year I had a company get bought by John Deere. It was a company called Bear Flag Robotics. And it was basically, they were trying to do autonomous tractors. You know, that makes sense. I would think that makes sense for John Deere, right? To have tractors that are autonomous.
That's awesome.
Right? Yeah. I mean, that's, and the funny thing is that company didn't have that much revenue. You know, the founder was a business school, a classmate of mine, and I wrote the first angel check. And listen, he had nothing. He just had a pitch deck, you know, but I knew his background. I worked with him, you know, I liked his character, his personality, all that. And I wrote like a $25,000 check. And then I followed on a little bit, and, you know, that 50K investment got me a 7-figure return in 4 years. So yeah, it was just, it was, you know, it was something times where like, hey, 4 years. My usual time horizon is, I would think 10 years, right? That's what I tell my investors as well. But usually you just never know. You never know. But it really has to be on an acquisition or an IPO. That those are the most likely.
But you think along a 10-year level, because a lot of what I hear and teach to people looking to get money is that investors are looking to get out in 3 years. And what's weird to me with that is that, like, where I sit now at like 15 million, right, in revenue, I get people that solicit me all the time. I mean, consistently to buy or invest, but I turn them all away because the valuation's not where I want it to be, because we still have a lot to grow. So I kind of think I would not be, you know what I'm saying? Like, there's opportunities to exit for someone like you that would come in to get out, but I'm not in it to exit it like whatever 20 million valuation. I want 100, and I'm willing to stick in and continue to grow the revenue to get there. So is that what you want? Do you want someone like me that's going to stick in there and continue to get the revenue to get us more return down the road? Or do you want somebody to get out sooner when they have those first initial opportunities to be acquired or whatever it may be?
Yeah, it just depends on, like, if it's my money versus if I have taken other people's money, right? If I have limited partners, which I haven't yet, I mean, I would want to ask them, because sometimes, like, when you invest super early, like we invest in a company called Cerebral at $12 million valuation. And recently they just raised at a $300 million round from SoftBank for 4.8 billion. That's a pretty good win from 12 million, 4.8.
That's a huge
so
win,
it's like, so like, why not like sell a quarter, you know, or like, you know, a third of the shares, you know, and let the rest ride. But then, hey, like, be safe with the investor money. Like, I would do that. But if it was me, I would still ride it out. Like, maybe I'd get my principal back and then go invest in something else, but then I would still want to ride it out, because that's just me. You know, part of it's kind of being a gambler to a certain extent. You know, I do play high limit slots, and it's just like, there's nothing like it, you know, and you have to be, but when you're running other people's money, I feel like you have a fiduciary responsibility. You should, you know, to do that. But me as an angel investor, like, hey, unless it's like, you know, they buy me out completely, like, I want to wait for that IPO.
Yeah,
you know,
that's interesting. I like that. Like you said, it's risk threshold. I'm the same way. Like, I only invest in super risky stuff, right? Either lose it all or it's an absolute home run. I'm willing to stick it out. Like, I'm in the rest.
It's like, I always tell it, like, empty the clip. Like, why are you saving something? Like, you know, I've seen companies like, hey, give back money because they didn't, and that's okay. That's okay if you want to give back money because you don't think you could go any longer and you want to do something else and the risk isn't there for you to take anymore. But usually, like, that's what I like seeing companies pivot again, you know, because it's the people who fail who are really going to win. Like, I know there's, like, you know, Warren Buffett's rule, like, oh, rule number 1, don't lose money. And like rule 2, don't remember rule 1. But when you're an entrepreneur, like, you're always losing money from the start. You're always losing money until you get to that inflection point, because you got to keep figuring out what makes sense. I mean, I would never want to be a Fortune 500 CEO. I love this part of building companies because you're going to find like all the funny things that happen to get there and all the luck as well that happen.
What question should I be asking you? Like as an investor, I'm gonna take the money. What are things I should be asking you that a lot of people don't even think about to ask?
I think really like what my investment philosophy and approach is like, because you could say like, oh, I'm going to go find the best seed companies out there, right? But that's just so generic. Like, do you have a certain like, what is your due diligence? What is like when you look like how many bets are you making? That makes sense because like, listen, if you raise, whether you raise $1 billion or 100 million or just $10 million as a venture capitalist, for example, like you have to have a strategy. You're writing like, if I'm raising $100 million fund, I'm saying to people, I'm going to make 50 bets, more or less, like 50 companies or 50 bets. Because sometimes you could double up on your one company, right? Because you believe in it so much. So that's it. Those are my shots on goal. Like that's it. Because you don't have an endless supply of bullets or ammunition to keep firing at the target. Like within this 3-year horizon, that's what I'm going to do. And then like people ask like, hey, okay, it's easy to have a pitch deck, but then like, okay, people ask about your data room, like, how do you view investing? And I'll be honest, sometimes it's a little bit of luck because you have to go out there. I mean, these deals don't come to you. You have to show people like, why are you the right person to give money to? Because like a lot of people, hey, they get fat and happy. It's like, hey, I've already made millions. Like, I'm not going to go out there and go network with some like 22-year-old kid who's about to graduate college. It's tough. Like the moment you don't want to do that, you got to get out of the game because you still got to go like hunting and chasing down deals because you don't win things just because of your reputation alone, because there's somebody out there who's younger and hungrier and wants it more.
What about negotiation? What if I'm interested in you investing? Is there room for negotiation? Like Marcus Lemonis always says, my first offer is always my best offer. Like, what does that look like with you? Is there room for negotiation? If I don't agree with value, where are the points that most people typically want to try to negotiate?
Yeah, I think like valuation, and when it's this early is okay. I mean, it's like you telling me to invest at 7 million versus 9 million. That's not going to make a huge difference. There could be like some funds or some people have like this ownership requirement. Okay, I understand that. Like I have to own 10% of your company, but that doesn't matter to me. What matters to me in this sense is really just like information rights. I'm going to ask for like side letters, like, even if it's a safe, right? And you're doing like a convertible note, I want to be able to say like, hey, I can get you on the phone, or like, you're going to show me quarterly numbers, that there's some sort of responsibility on yourself, not because you just take the money and I don't hear for you, for like 6 months to a year. I just want to be able to say, hey, I want to be able to get on the phone and see what's going on with your company. I've made mistakes in that in the past, or like, I've raised a lot of money for someone and he just disappeared on me and just made decisions on his own. And like, I hate that, like, because I feel it's a true partnership when you get money from someone like myself, because, it's not always going to be good and it's not always going to be bad. I tell people like, I'm your in case of emergency contact in the business sense. Like you got to call me with good news and bad news. So see how I can help and not wait till the last second when it's all over.
And what do you want? I mean, how much say do you investors typically want? Does that change between angel and VC? Because like, for example, yesterday I was talking to a venture capitalist and it's like, I told her, I said, we're not ready for money because like, we're not ready for parental supervision is how my partner and I describe it. Like we're having the time of our life. The company's healthy. We raise money. Our margins are good. So it's like, we want to have fun. We don't want to have other people to answer to. Right. But then because we don't know. So what does that look like for an angel investor versus venture capitalist? How much control you want? How much say does the investor want into what's happening?
Yeah, I think also it depends on how much money you invest, right? Most of the time, angel investors don't have that much like say, right? Because they're not writing like the entire round of a check, right? Whereas a venture capitalist, like, hey, I'm leading your entire round. Like I'm looking potentially for a board seat, right? Or like I have some say in how you spend the money. Like that matters to a venture capitalist. For an angel investor, like some, depending how big of a check they write, they would want that. But for me, I don't, because I don't think it's going to make a difference when it's this early to have a say. I just care about you growing enough to get to the next fundraise.
And how do you become an angel investor? Like you mentioned having partners in deals. What if I want to get in and I don't know much about your industry, but I'm interested in investing into businesses through you? Is that those type of things possible?
Yeah, I mean, like I tell people, like, I'm not here to just like get my own slice of the pie or the pizza, right? Like I just want to grow it bigger. And I think like you have to brand yourself of what you are good at and how you can help companies or people. And so like I'm not great at certain things. That's why I need to have a network of people who are good at certain things to help. Like, if someone's a great salesperson or someone has a great contact or someone who's great at like operations, supply chain, or finance, like that's what I need. You have to be able to brand yourself to see what you're good at. I would say I'm good at like operations because of my family background in the contract manufacturing space and working with retailers and wholesalers versus me coding. I'm not a good coder, right? I don't know Python, but I know, like I know who I need to hire, right? For a great software engineer. But you have to make yourself useful in that sense. And it's not just having like, listen, it's easy to become an angel investor if you have money, right? You're throwing checks elsewhere, but it's a difference of like having a strategy with that money.
Love it. So many other questions I have, but we'd run out of time. So where can everybody go to learn more, maybe talk to you if they think they have a business? Well, before we even do that, what exactly are you looking for where somebody listening or watching this can say, I need to give him a call. He might be a good fit for me.
Yeah. Just take a look. I do a lot of blogging on my website, jonathanhung.com. There's a bunch of YouTube videos. If you just Google my name as well, about like how I talk to my entrepreneurs. Like it's called Ask an Angel. See how I ask them and see how it all started. It's always great. And you can always find me on LinkedIn. I always tell people, I think LinkedIn is the best way. If you're looking for someone in the business side or professional side, it's not Instagram, it's not Facebook, it's not TikTok. It's more, looking for true ways of finding people with professional and business contacts and relationships.
All right. I love it. Thanks for coming on with us today.
Of course. My pleasure, Ty.
So listen, if you're listening or watching this, hopefully this opens up your eyes. It makes a lot of sense because the reality is there's a huge benefit of not just being able to get money to grow the business, but having a partner involved that also has a vested interest in the business growing, not just a little bit, but growing substantially and being successful. And this is why angel investors make so much sense because they can help you in so many areas that you're just not versed in and avoid problems in a lot of cases that sometimes before they even occur. So if you're interested in learning more, you've got to go to jonathanhung.com because jonathanhung.com, it's fantastic. You can submit your pitch deck right here. You can ask an angel questions. You can come in and even check out his blog, which I'm actually going to subscribe to and pay attention to because it answers a lot of questions that you may have about getting investment, when the right time is, everything you need to know about successfully obtaining angel investing. So make sure you visit jonathanhung.com. That's jonathanhung.com to take the first steps towards getting investment into your business. Thanks for tuning in. Have a great day and make sure you visit jonathanhung.com.